Let's be happy to meet here again for a panel discussion we are doing here on behalf of the Blockchain Center. Today we want to discuss business models in the domain around assets as a service, and we will also explain what this is exactly. This directly affects the urgency for stablecoins, which can be, but don't have to be, a driver of such business models. We now have had the announcement of the US company Circle to launch a Euro stablecoin, not from the EU, but out of the USA, which is a strange situation. So we will also discuss the impacts of this for such business models of the future, assets as a service, pay-per-use, and so on and so forth. And finally, we might also discuss policy implications of such a stablecoin in euro denomination coming out of the US. So how does it affect European businesses, if at all, right? So with this, I would like to directly jump into the discussion with all of you and maybe ask everybody here to briefly present himself, herself, and the company before we then jump into the first topics. Who wants to get started? Maybe Max, would you like to get started?
Well, thanks a lot, Philip. My name is Maximilian Foster. I'm co-founder of the company, which is highlighted in the background. It's called Cash and Ledger. We basically brought live one of the first asset as a service business models, and we have a live implementation with a tractor company based in Austria, mostly around Lindner, the use case. Some of you already know it. We're already in talks and already executed other projects, which I'm not able to talk about, which are definitely existing. So we see a significant drive in this topic, and one of the software providers in the space in order to enable such pay-per-use and asset as a service business models.
Perfect. Then Florian Forst, would you like to go next?
Happy. Thank you, Philip. Thanks for inviting us to the panel. I'm partnered with Arthur D. Little. I'm based in Munich, and I'm covering the German-speaking countries for Arthur D. Little. What we do, basically, we are kind of management consultancy or strategy consultancy, working with our clients, finding kind of practical use cases for blockchain. And in this context, asset as a service is a very attractive area, and we have many discussions with clients on finding ways and using blockchains in that. And just recently published together with Max and yourself a paper on asset as a service. Happy to discuss the topic here.
Exactly. We will explain this in a second because that was the original idea to also discuss this today. But let's go with Agatha next. Please also present yourself.
Thank you, Philip, and thank you for having me here. My name is Agatha Freire. I'm a lawyer by background, and I have been researching and studying the cross-section of law and technology, especially decentralized technologies, for a while. I have an academic background, professional background, and currently I am also Chief Legal Officer for Status.im, which is a Web 3.0 company.
Great, thanks much. And finally, we have Benjamin Schaub here.
Thank you, Philip. So my name is Benjamin Schaub. I'm the Chief Digital Officer at Intas Tech, which is a blockchain consulting company that has been set up by the Frankfurt School and by Plutoneo. And we are focused on mainly all the use cases around crypto or tokenized assets. So we are looking into aspects of integrating crypto into existing infrastructure, integrating tokenized securities or fund units. And of course, we are also looking closely at use cases across the industries. Therefore, we are grateful to be part of this panel discussion today.
Perfect. Thanks much. And with this, let's directly start into the first topic, which is basically business models, which could potentially apply the digital euro. Today, we have decided to not talk about the European Central Bank. We know that the ECB is acting very slow, but the digital euro has two aspects, right? One is the aspect from the central bank, then it's called CBDC, which is called central bank digital currency. The other half of this topic around digital euro is stablecoins. That's basically tokens running on blockchain systems, which can take the form of the US dollar and the euro. And today we would like to exclude the ECB topic to the most, but also include stablecoins as also a potential driver for business models around assets as a service, pay-per-use, and so on and so forth. And as already said, we have written a very nice paper around assets as a service together with Cash and Ledger and also Arthur D. Little. That was a couple of months ago. And subsequently, we then decided to also bring this topic to this panel discussion round. So therefore, let's get started. Maybe Max, please explain what exactly is assets as a service, what is pay-per-use business models, and how important is the digital euro there or not?
Yes, well, thanks a lot, Philip. And I think asset as a service already, like, even if you don't know the term, you definitely have been, like, facing one of the products here already, because asset as a service is not new. It's around the corner since 2014, first and outmost known by the sharing economy. So you all might have known, like, all the sharing economy cars, so Drive Now, Share Now, whatever they call it right now, or Airbnb or Uber. Basically, what you do there is, like, you have one asset and this has access to many users. So this was one of the first steps of asset as a service. This is a consumer trend where people don't want to buy assets, but they rather want to rent it for the period they're actually using it. So they only want to buy for the fact using instead of like basically owning these assets. This trend slowly captured not only the B2C markets, but rather also the B2B markets. So if you have a look at, like, the German industrial landscape and the manufacturing landscape, you would actually see that we have a lot of like mechanical engineering companies, and all of these companies start to investigate how they can actually increase the profitability per each and single product or asset they produce. And ultimately, what they figured out is that you can increase it with a servitization approach. And servitization means that you not only sell the product, but you sell additional services. And with having asset as a service in mind, so that you don't sell these assets anymore, but you rather rent them out, you basically create a leasing 2.0. And this is significantly important for all of the mechanical engineering companies and all the other OEMs out there, because you have a lot of like insecurities around the markets currently. So you have wars, you have a corona crisis, a COVID pandemics, you have a lot of like insecurities on the market standards, which basically fosters smaller companies to not do significant investments for long-term periods, but rather rent basically products or machines or any kind of assets like for the specific use they have. So you have a shift in like another mindset that people don't want to own anymore, they just want to rent, and they're willing to pay a higher price because they know exactly that they can get rid of it and don't need to account for it or have long-term like investment relations towards these assets. And this is what is called asset as a service. It's also called equipment as a service or pay-per-use is one of the forms of it. But ultimately, you talk about like, instead of pure sales cycles that you sell a machine, you basically rent it out and basically only pay for what you use the asset for.
Great. I think it was very helpful. And let's move over to Florian. You are working at a consulting company, so apparently you see a demand there or maybe also no demand. Would you like to add something here, maybe also corresponding to what the demands by the industry is?
I think that's a very good description of the model by Max. And I think the beauty of that is that you're kind of splitting production, ownership, and usage of an asset. Because assets tend to get more and more expensive, so companies have a hard time to always buy it. But there are companies, for instance, insurances, that have sufficient kind of funds that would like to find assets that would like to invest in. And that's basically, it's a kind of really circular economy, because you have some investors getting highly interested in new assets they could invest in. That's number one. Second, you have a user who has not the funds to do the investment to get the machines. And then you have a producer who is, so any kind of OEM, he's not equipped or he's not kind of set up in a way that they would like to keep the machine they're building on their balance sheet. They would like to get rid of the balance of it on their balance sheet. So that's the idea. You're moving the machine, which is extremely expensive, somewhere on the balance sheet of someone who has enough funds, but not necessarily needs the machine as to use it. And the user basically gets access to it. From a macroeconomic environment, it makes sense as well, because a machine is then produced for many users and not only for one user who is buying it. So you basically do the investment only once, and then the usage is done by several. And this kind of idea is interesting from many perspectives. Given that we are supporting mainly financial services clients, for sure, our clients are very much interested in the investment opportunity. So in the ownership of the machine, but not in being the provider of the services. The provider is than someone else. And I think that's basically creating new investment opportunities with kind of guaranteed returns if you find someone who is managing the asset in a proper way.
Yeah, I think that was a very nice description, and I will basically try to repeat it, and you let me know if I hit the point or not. So right now, a machine manufacturer is basically selling a machine, and the machine is then being financed by the manufacturer. The machine is being purchased by the customer, right? And then the machine is being in the books, in the balance sheet of the customer for, say, 20 years, right? So the machine is there for 20 years. That means that up until this point in time where the machine is fully depreciated and fully gone, after 20 years, you have to do accounting, you have to do invoicing, you have to do all kinds of controlling measures. In case you are doing mistakes here, then you are thinking that you have earned money, but you might have not, because it's basically a very long-term perspective you have to operate such a machine, right? That's basically how I have been educated with regards to production processes and so on, and distribution of fixed costs across many products being sold. And this pay-per-use business models and also assets as a service now twists this, because it means that the delivery of service, so what is being done by the machine, then the payment, that's the invoice, and the accounting part, that's the depreciation stuff, is being moved over to one point in time, such that the finality of this transaction happens after, say, 5 minutes or 10 minutes, or maybe 1 hour, maybe half a day, right? So this eases accounting, it eases things a lot, it changes the balance sheet, it changes controlling a lot, and so on and so forth. And it also moves over the financing part from the customer to the capital market, because some kind of anonymous crowd could potentially invest in the capital stock. Like my explanation was now, I don't know, maybe a little bit more abstract, meta level, but I wanted to add this, and would like to ask Max and Florian if I explained this correctly, or if you would like to add something.
Yes. So basically, Philip, to basically give our audience a kind of a concrete example of that. You explained it definitely well, and from a theoretical perspective, perfect. But just to make it concrete, and just to give a great example of it is, if you think about hydrogen and the mobility crisis. So currently you have a lot of or a huge trend is that particularly in the transport business and the logistics business, you will use a lot of hydrogen trucks. These hydrogen trucks, in comparison to normal diesel trucks, are pretty expensive. So if you compare it, the price, a diesel truck is around 100,000 euros. A hydrogen truck costs you up to 700,000 to 800,000 euros. So you can buy 8 times a diesel truck instead of buying one hydrogen truck. If a logistics company with a pretty margin low business, still decides to buy one of these hydrogen trucks, you still have the insecurity of the business itself, because you don't have the infrastructure for it. So we don't have the necessary hydrogen gas infrastructure that you can basically operate these trucks. So worst case scenario, you decide to buy a truck for 800,000 euros. It stands around basically on your field or on your site, and you can't really use it because there is no kind of gas station around who actually serves you hydrogen powered fuel. So ultimately you have a lot of insecurities there, and particularly for a margin low business, as the logistics industry is currently, and we all know that it's basically not feasible for them to buy such trucks in years and the next years to come. Okay. So for particularly exactly this reason, you would need a kind of a low capital intensive entry point. So you need what Florian just outlined, insurance companies, buying these truck fleets, renting them out. Or what you just said, Philip, is that you basically have a crowd investing in these trucks and preparing them, or letting them basically fly on the street. That you don't have these high initial investment costs, that you reduce them to the maximum, and that the transportation companies can try it out. Because only with the try and error, you will get more and more people to adopt hydrogen truck fuels. And with that, you will only be able to increase the fuel stations. And with that, you basically kind of overcome this crisis, or you can overcome this challenge of building up an infrastructure instead of building up only trucks. And with that in mind, you would actually see that this asset as a service business models, can also solve these challenges for insecurities, not only regarding the markets, but also regarding technologies and infrastructures. So with that, you ease up this process, and you ease up this high initial investment cost for these small companies in order to basically enter new market spaces or enter new product spaces.
Yeah,
I think it's a perfect example. It's a perfect example because most truck owners, they have up to 100 trucks, and these are really large fleets. So they are not used for these. They basically don't have the capital to do the renovation of their fleet. And it's a perfect example how basically new technology is in this context fostering the change towards a kind of more eco-environmental transport means. Perfect example.
Yeah, thanks much. And we soon head over to the digital euro. But before we do this, maybe Florian, you mentioned a very interesting point in our prep call, because you said that sales cycles might decrease on behalf of manufacturers. That's basically an argument I have never heard before, but it makes sense. So maybe you can explain this argument, which is maybe a little bit counterintuitive in the beginning. Yeah, but why are sales cycles being shortened down with such new business models?
So I'm not quite sure what you're referring to. But, so at the end of the day, I think there is no sales cycle in that kind of context. The point is, I have the kind of access towards the asset very quickly. And the asset is around, is already used by someone else, and can easily kind of get access towards that asset provided by someone. I don't have to wait until a very complex asset is produced. So if you take again the hydrogen truck, until the truck is produced, it takes really, really long. If it's already around and used by, I'm only pay per use, I can have easily access towards such an asset, and can easily, quickly kind of put that into my fleet and use it when required. And as such, the kind of access towards the assets, given that I'm using the asset that is already around, is much shorter than waiting for getting a production.
Maybe,
okay, excellent.
Maybe Philip.
Yes,
maybe
please.
Philip, to add up on that, like from one perspective, just to again, like give you a great example of that. Is like, think about an SME company. Like, think about the typical SME company having 40 employees, being like a mechanical engineering, or like kind of like plastic industry, being like these companies. Maybe having like a balance sheet of around 5 to 10 million. That's like what the annual turnover like basically displays. And then you're in need of buying a new machine. This new machine is usually, as Florian outlined, like pretty expensive. So they usually range around 500,000 to 1.5 million or 2 million euros, depending on the size, depending on the outcome, the basically attributes you want to have for the machine. Looking at these numbers, like ultimately, having like basically a machine which is 1.5 million euros like expensive, and then you only have like 8 million euros in turnover. Looking then at the market conditions, where you have a war, where you have like kind of like going from a low interest rate from the European Central Bank to like a high interest rate, or like exceeding interest rates. Plus, additionally, you have like the COVID pandemic, where you don't actually know whether you will ever reach the break-even point for this machine, and you only have like kind of like orders for this machine lasting for a year or two. But you have a financing plan launching like resting for 8 to 10 to 15 years. You basically have like large insecurities in like whether you should buy this asset or not. And this is like the reason. This might not be true for all of like your customers, but a large part of the customers still would ask themselves the question: would I rather buy this machine, or can I get a chance of like just rent this machine for a specific period where I for a fact know that I have like orders, and like whenever this period is over, I would actually pay either less for the machine because it's not used, or would even like return these assets because I know like after 5 to 6 years I can return it and they refurbish it and I can send it out to the next client. So ultimately, like this is just like not like kind of eradicating all sales cycles. It's just a second like footstone or second foot for all of the OEMs, and like presenting a financing option for the clients in order to have like kind of a more financial flexibility that they can basically like get these assets and like use these assets. And this is I think not a demanding like decreasing sales cycle. It's just basically a market condition, and like with like basically like increasing interest rates, some companies will start to ask themselves the question: should I buy or should I rather rent these assets?
Yeah, makes sense.
Yep. The kind of access towards innovation is then much quicker. So I have the opportunity then to stop a specific machine and to kind of, if there's innovation in the market, to switch towards another provider.
Okay, let's move over to the importance of the digital euro. Why does the digital euro make sense in such business models? Is it a must, or is it a nice to have, or is it maybe a nice to have for experiments, but still a must for bringing such business models at scale? And then we are opening up the round for everybody also here to include Benjamin and Agatha as well. Florian, Max, would you like to start?
I'm happy to start on that. So basically, in any kind of given environment where you use asset as a service, the digital euro is not a must to have it. But you can build any kind of payment mechanism at the back end of the system. So the infrastructure built by a player like Cash and Ledger is kind of measuring the usage of the asset, and then basically is triggering by this usage the kind of payment mechanism. And then the payment can be whatever you want. However, given that you talk about micropayments, the kind of most efficient payment would be the right way to do that, because then the overall model gets cheaper. And I think that's a linkage towards the digital euro, that when you go to, if you use a kind of credit card model behind it, probably it's a kind of costly, given that we talk about micropayments, because especially if you use, for instance, the Lindner tractor for just 1 hour, it's a very limited amount of payment that you're due to. So, and the more you're scaling that down to smaller kind of usages, the more you have micropayments, and the more you would need efficient payment mechanism.
Perfect. Max?
Yes, 100%. Basically, I agree with Florian. And, to just bring, the perspective from the clients, ultimately, payments and transactions is always something which needs to work. There is no specific, innovation in that space. If you would have asked me, in the 90s, hey, there is, new online banking and you can just send money, online from point A to point B, I would say, so what's the value in that? So, ultimately, payment is not something which is very innovative for the consumer. It just needs to work. It's just, it needs to be seen as a kind of an infrastructure which is there. But for these use cases, and Brian just outlined it perfectly, we're entering the space of would not even say digital euro, programmable euro, but it would say ultimately in general sense, you enter IoT payments. So you enter that the tractor is paying basically the amount due from the client's account to the account of the owner of the tractor. So, and for that very reason, you would actually need to have more sophisticated infrastructure. And ultimately, if you would ask me point blank, do I need a digital euro for asset as a service business models or a stablecoin? I would say no, you don't need it. The point is, once you enter it, once you enter the asset as a service space, and yes, you enter asset as a service business models, ultimately you would actually see, or you actually foster process excellence and process automation. And this only comes with automation. And automation can only be happening once you have a programmatic infrastructure, and that results ultimately in a programmable payment. I would specifically frame it like this, because it's not necessarily you have programmable money, but at least programmable payments. And how this is executed, there is a variety of options, and I'm happy to discuss the stablecoin option, as well as programmable payments from the banking side, so from commercial bank side, as well as from the public side, so from the ECB. That's all up for discussion, but ultimately for this business case in its initial phase, it just simply have an introduction between the client and the OEM. You wouldn't need it. As soon as it gets more complex, where you integrate insurance products, where you integrate several players, other investors or stakeholders, it becomes more complex. And with that more complexity, you would actually need to have something which is programmatically solving this complexity. And this is where programmable payments and this programmable money infrastructures will come into game, and we'd actually need them.
Yeah, very interesting. And with this, I would like to also finally, sorry for taking it so long, include Benjamin as well, and also Agatha. Let's talk about stablecoins. Where are we right now? Are there stablecoins existing? Are there no existing? Those that are existing, can they be applied or not? Agatha, would you like to maybe take this first question? Where are we with regards to stablecoins? And maybe, you are also working in the DeFi sector. What's your view on the discussion around assets as a service coming from the, let's call it, anonymous DeFi space?
Well, in terms of stablecoins, they have been around for some time, I think since 2014. And with Tether, I believe, was the first one. So over time, the stablecoins, the market capitalization grew, although recently it decreased dramatically, but the stablecoins became a very important fundamental layer of the crypto space in general. And it comes as a response to volatility of crypto assets, volatility of traditional cryptocurrencies. So it's a very important element in this whole DeFi puzzle and the DeFi structure. So in terms of the fundamental reason for their existence, they are quite important and I would say indispensable in crypto space. Where we are currently, the dominating stablecoins are US denominated, with all the other stablecoins being very marginal, and that includes euro as well. So what we are seeing is dollarization spreading around through stablecoins. And in terms of European situation at the moment, the legal and regulatory framework for stablecoins is very fragmented and uncertain. So what the EU regulator is doing is working for the last 2 years on a very comprehensive regulation that will govern all stablecoins in Euro market. We will probably see that regulation, so-called MiCA, coming into force in the next year to up to 2 years. And that MiCA regulation will mandate specific conditions and regulatory compliance obligations for all stablecoins in Europe. And the approach of the regulator is to mandate certain technological and setup for stablecoins. So they will have to be designed in a particular way. And there will not be much room for the innovative design stablecoins around. And clearly this will be a very comprehensive regulation. So it will require a lot of resources will be required to comply with this regulation, to go through the hurdles of the regulation, and the whole stablecoins market will be highly controlled by the authorities from the point of view of monitoring and supervision.
And if we talk about the stable coins which are already out there, Tether and also other ones, Circle with the USDC, they are already used primarily in the DeFi space. But maybe one question to Max: why can't you use such stable coins which are already existing for asset as a service business models? Where is the issue here? Why doesn't it work?
Well, you can, as long as you have a regulatory stability and you find a regulatory setup, definitely you can. The simple point is the adoption cycle. So if you just shift it around, from purely perspective, we can technologically integrate a stablecoin in this offering. We can definitely do it. I mean, whether this invoice is settled with a euro or stablecoin doesn't really make it much of a difference. But the point is that you will need to have the acceptance by the crowd and by the people. So you would need, in our example, let's take Lindner, because it's quite easy to explain. You have a tractor company based in Austria, and then you have the clients, which is usually a farmer in Austria. To explain a farmer in Austria who is not really who I suppose is not really tech savvy, that they use stable coins. I would actually say they wouldn't use stable coins because ultimately they want to see the euros in the bank account. So ultimately for them counts that you have a euro in the bank account, and what lies below as a kind of a payment mean, whether it's a stable coin, SEPA infrastructure, request to pay, any kind of other payment mean, they don't really care about. So I would rather shift it around and say, if you have enough critical mass in using stable coins, you would definitely be able to integrate them, and it would definitely make sense to some extent. And you already outlined also in the paper about the weekend, for cross-border payments, definitely makes sense. And you can find regulatory ways how to implement it, definitely. But the point is that you need to have the critical mass by the people, that they accept stable coins and they accept stable coins as a means of payment. If you don't have that, I would say it's not really feasible for the companies to integrate a stablecoin offering, because nobody's using it, and why would you integrate it then?
Okay, and Benjamin, you're also talking a lot with companies in Germany, primarily from the financial sector. Do you see some adoption coming on this regard? Is there a potential application of stable coins in our real world with wallets and all kinds of things? Or is this basically not existing, which would then also mean that stable coins are just for the DeFi space, and for assets as a service business models, B2B topics, we need other solutions?
No, I think it's a huge pain in the industry right now. So we have in many use cases, it's possible to tokenize assets, assets as a service, and then you need to have some payment mechanism. And this has to be done up to now in the traditional world. So you need some kind of SWIFT trigger payment and so on. And therefore, it would definitely, from the technological point of view, make sense to integrate stablecoins, for example. And then we see in general more adoption regarding, let's say, tokenization of assets, could be also financial instruments. But still we're lagging how to deal with it. And I think what has been said so far, the point really is when we talk to clients, then they want to understand how is this process looking, you know, really in the final version. They want to understand what kind of efficiencies they can realize. And if you don't have a means of payment in the blockchain world, then this is definitely not helping at all. So I would, because we had the question before, I understand that from a technical point of view, we do not necessarily need it, but I would say it's a must for the industry to have such a solution, because then in the long run, we can really streamline the process on one technology. We don't have the frictions where we say, okay, we can do parts of my use case in the blockchain world. The other part will be in the traditional world, especially regarding payments. But what was always also said by Maximilian right now is, of course, we need a critical mass, right? And up to now, we haven't seen any of this in the financial industry so far in Germany, I'd say, or in Europe. And we can only hope that with an opportunity and a euro-backed stablecoin where we see significant volumes, that players will enter the space who see this as an opportunity and say, okay, for me, it's important to have the euro, and therefore I will then maybe approach such a use case. But so far, I think it's a green field where you can really gain market shares if you are one of the first movers. And I'm very interested to see what DZ Bank is now doing, because they recently just announced that they are also entering a pay-per-use offering, including blockchain. So it will be interesting to see also how are the payments being done here and what's their vision maybe for what's their roadmap for the next few years.
If I can also add, I think that critical mass also doesn't necessarily concern only critical mass in terms of acceptance of stablecoins. I think as soon as we have a critical mass in terms of DLT-based use cases, then at some point there's always going to be some friction between the DLT world and the traditional world. So if that DLT critical mass will increase, then obviously there will be a need to reduce that friction, and then the need for integrating DLT-based payment solutions will also be bigger. So that critical mass have to grow on both sides, on the use cases side, and then that will bring the necessity on the payment side as well.
I think, Agatha, that's a very good point, because I think right now these asset as a service models are kind of niche models. As soon as these models move out of the niche, a kind of more advanced payment mechanism like stablecoin mechanism is driving it strongly. And I think that goes very much in sync, both parts.
So maybe to add up on that, I can also add up what Benjamin just said about like the DLT solution from Volksbank. I mean, ultimately, if you have a look at it, like, you know, it's just still the wrong angle, because like as Florian just outlined, you need to take it, like, you know, you need to take the market, like, you know, drive. And I got you entirely right, like, you know, DLT use cases are definitely driving. So you need to have, like, you know, kind of like a solution, like, you know, with stablecoins or without stablecoins, for also other problems, not only asset as a service being one of the problems, but also other problems in the market, like DVP, stock exchanges. There's a lot of a variety of problems. So you can basically, you know, also take that critical mass, 100% given. But then, like, you know, looking at asset as a service and pay-per-use business models, you need to solve a variety of other problems than, like, you know, what DZ Bank is currently doing, because you're just building up a trigger solution which can only be used by a DZ Bank. So there's not really big need of it. Like, you know, we already did that, and we already like been there and, like, you know, tried to figure out, like, you know, payment transactions, but it's a really, really small part of it. So, and what Florian just said, like, as soon as these business models move out of the niche, as there's more and more player entering it, and you have more and more player within the previous years, they all started off, and they all have their discussions right now. We at the forefront, so I can definitely tell you, like, all the industries are currently talking about how can we move into the servitization field. I guess as soon as you have this market grasp and this market drive, then you can basically think about transactions. But like building out a blockchain and DLT payment infrastructure for a problem which is currently not even solved by blockchain and DLT raises, at least in my head, some questions which you would actually answer in the future, because they're trying to build up a model in the future for the future. So I would rather, like, you know, build a model for now, like to basically bring these models, this asset as a service models live. And once you have them live, up and running, then you can basically alter this automation aspect, and you basically start off like, how can we make them even more efficient? Then it makes sense. But building up like, kind of like a future technology for a future problem is always like, kind of like raising questions in my head. That's why I would say like, for future, it definitely makes sense. And stablecoins definitely have their points here, but, and like, for various DLT problems as well. But following the trigger payments solution approach, what DZ Bank is currently doing with their solution, I would not see that like, ultimately kicking off, because the clients still need to understand pay-per-use and asset as a service as their business model. And then you can start about like thinking about technological integrations.
I think that's an interesting
approach. The problem with this approach might be from the European point of view is that we in Europe can still rely on the traditional financial services. So you don't see that need right now, because you can execute your payments through traditional payment system pretty much on an efficient basis. However, in other parts of the world where there is that reliance on financial service cannot happen, I believe these DLT payment structures will be developed in parallel with the DLT use cases. So there will come a point where we in Europe might not have developed DLT payment solutions and may not have this competitive advantage over those parts of the world where this development was driven through the necessity of developing those payment solutions earlier.
100% taken. Just Florian, if I can just answer that, like, don't get me wrong, I definitely see the need for stablecoins then, like particularly for underbanked nations. Don't get me wrong entirely, but taking again, like, the glasses of pay-per-use and asset as a service, this is primarily a business model for the Western and industrialized markets, because you need to drive like, kind of like a market adoption rate, like, whereas in other parts of the world, you would definitely still have the sales cycles because of like, positive interest rates, because of a variety of factors, like, particularly, but in the Western markets, you see pay-per-use and asset as a service as an extension of your current business model. And therefore, I highly doubt the approach of like a single bank offering like, a single integration of like, not even like a combined or standardized approach, but like, building for their own infrastructure payment solution, which is kind of DLT based, not even blockchain based. That's what I see highly questionable. I don't question like, the approach of stablecoins. They're definitely like worthwhile, and they definitely need to be there, particularly like, for cross-border payments. There's definitely the use case there. But I rather see like, this kind of like, kind of like broken leg approach of like, building up a DLT infrastructure and then building it for the own bank, that you basically provide like kind of trigger solutions for DLT infrastructure, which is not needed like in the Western markets currently. And like, being an isolated kind of like, approach, that's what I see questionable. I don't question like, that you need to prepare for DLT infrastructure, you need to have an integration. And therefore I see stablecoins because they're unified like for everyone, but not like, a single bank approach. So that's what I see questionable in this approach. If you understood it now correctly. Sorry for I didn't want to.
What it nicely carves out of this discussion and basically reflects as well our belief on the DLT infrastructure is that asset as a service is a kind of first step, and around asset as a service you can kind of build quite a lot of things, enlarging as well the kind of DLT infrastructure. So you can kind of embed stablecoins as payments later on, but you can as well move with the assets to a kind of tokenized world where basically through tokens you create asset classes for kind of individual investors. So why shouldn't I at some point of time have the opportunity to invest in a kind of interesting machine where it's a kind of where I generate a high return as a person as an individual investor. So basically I think this generates quite a lot of opportunity to use this technology in many dimensions. So currently it's used mainly as an infrastructure to make this whole thing work and to make sure that basically the pay-per-use model is somehow orchestrated in an efficient way. A kind of second enlargement would be then using stablecoins or any kind of other virtual currency as payments mechanism or its payments mode. And finally, you can basically tokenize the assets as an investment. So it gives quite a lot of opportunities to use these technologies in many dimensions, which I think is a very cool use case as well.
Yes.
And Benjamin, because you talked about delivery versus payment, let's go back here again, because delivery versus payment would make sense that basically you have the euro or the dollar on a blockchain system. You also have a stock or some securities instrument on a blockchain system, and then the trading takes place through smart contracts. This would then mean that you can, you do not need to have clearing houses anymore. In my mind, this is one of the game changers at all, removing clearing houses, but rather do all trading through smart contracts. But at the same point of time, it would require having stable coins in form of tokens on blockchain systems, and it would require having securities on blockchain, right? At this point of time, nothing is on blockchain yet at scale in terms of legacy securities. Do you think that this will change at some point of time? Has this change already begun, or is it something for the future? Because I would like to carve out the following questions. Do stable coins make sense for B2B environments, or is stable coins rather something for peer-to-peer environments? That's what Agatha has been saying, or for smart contracts of the crypto world. Yeah, does it fit together or not? That's basically the question I would then head towards, Benjamin.
So yeah, definitely the tokenization regarding securities is starting. We can definitely say that because given other topics we have in the European Union regarding let's say securities as such, I see a positive framework coming up. We now have the DLT pilot regime, for example, which is coming next year. And especially in Germany, we have some use cases which are possible regarding, for example, the issuance of bearer bonds and now also crypto fund units. So definitely a yes here. This will definitely come and increase in, I say in the near future. However, of course, we then have to, as I said, the payment lag, which is missing. Will stablecoins be used for that? I doubt it, to be honest, right now, because of when we take a look at it from the view of financial institutions, then they look at counterparty risk and so on and so forth. So they will have then to look, okay, I have the issuer, like for example, Circle, then I have a custodian, which from the USDC is the Bank of New York Mellon, which is very positive also regarding their balance sheet. But this is really the question, will they look for it? What I can definitely say is that when we talk to our clients, be it banks or asset managers, and we talk about what can you do currently, what kind of efficiencies can you realize up to now, then they all hate a bit that there's always aspects of use case which you currently can't do. You can't do most part of the KYC on the blockchain. You have to do it still with paperwork and so on. Then you have the payment rails where you have to go in the old infrastructure. So I just want to emphasize that it is very important to have at least the option to have it all on one infrastructure. This is where they are all looking at, and I think that the adoption will then really take place if it's not okay. Out of 5 things, you can do 1 right now. This is the tokenization of a security. The other 4, for example, you can't do. But to get back to your question, it will be very exciting to see if stablecoins will be a solution here. It could be because simply, although we would like to skip this part, we simply don't have any other blockchain, other option to do it on the blockchain. Yeah? So if the European Central Bank takes another 12 years, then I think stablecoins will definitely be the go-to solution. But in the near future, I'd say most of the German financial institutions will be a bit skeptical.
Any points to be added by somebody? Because, Benjamin, you would then this would ultimately lead to the following situation, that in case we are having stable coins on blockchain systems, this would be for the peer-to-peer world, across the world, point-to-point, but peer-to-peer, individually, plus smart contracts and so on. And in case we are talking about the B2B environment, dealing with companies, that's basically the perspective of Max and Florian, then this would not be the stable coins. Yeah? Does it make sense to split the world black and white as I did, or is it not that easy?
I could jump in here as well. So I personally would say that it could really help in a B2B context, like what Cash on Ledger is doing, because, you know, from a company perspective or machine manufacturer perspective, let's see what the next 1 or 2 years bring economically. I mean, this is a time of crisis right now. This time of crisis could also foster a movement into asset as a service. And then as a machine manufacturer, you could drive and say, okay, you know what? I still want to be alive in a year or two. I need to transform my business model. I need some kind of option, and then I will go for a stablecoin. And then it can only be the critical mass that you as a company approach your bank, and then there will be some bank who says, okay, I'm okay with handling stable coins, and then it could also be a movement from this angle. So I think in the end, it's up to the companies who are producing machines, for example, very expensive machines, to maybe also get their financial institutions to interact in such a way.
Anything to be added by the others?
Well, the time of crisis always brings the search for efficiencies and the search for savings and cost reduction. And if these solutions can achieve that, then that may accelerate innovation, because as we've seen in Corona times, the innovation has been accelerated. We are now meeting online and we weren't before, and so on. So it might be that the crisis will bring the drive to innovation, to searching for new levels of efficiency.
That's an interesting pointer, because we have now heard that last week the US company Circle is launching their Euro stablecoin out of the USA, right? And maybe towards Florian and Max, you are dealing with primarily German or European companies, I guess so, right? So for you, it doesn't make sense to use the US dollar stablecoin anyway. So it's a stablecoin and it's a US dollar. Why would a company in Germany have this, right? But in case now Circle is launching their Euro stablecoins out of the US, is this changing your opinion towards this entire topic and towards potential solutions for the market? Could you do something with the Circle's Euro stablecoin concerning the products and solutions we discussed, or is there still a misfit?
I think at the end of the day, it's a question of business case. So if I can easily show my clients that using a stablecoin, and in this case nominated by Euro, is making the payments of any kind of asset as a service much more efficient and generates a higher return, I think there will be some openness in using it. For sure, there will be a kind of risk assessment, how much kind of risk this involves to move from a kind of traditional payment mechanism to this kind of payment mechanism. So from my perspective, there is a perspective. There is no currency risk involved, given that it's Euro nominated. Therefore, there will be kind of openness testing it. Other risk assessment would be required, and if the business case is easy, I think there will be demand for it because it squeezes out a higher margin. And at the end of the day, these kind of models are interested in returns, and therefore they would like to generate a broad return.
Maybe to add up on that, and to also add up on the first question, Philip, like, I think there's always, like, you know, a dominant design battle. Like, ultimately, like, you know, you have a variety of options, and, like, you know, ultimately, like, you know, the mass or like the demand decides, as the open market is currently designed, the demand decides, you know, what's going to be the solution. So like you can actually see it in the CBDC discussion. So the central bank digital currency, there is a huge discussion around how should it be done? Should it be like, you know, wholesale? Should it be retail? There's a variety of options. The same goes for, like, you know, programmatic payments. Should it be a token? Should it be commercial bank money, or, like, you know, tokenized commercial bank money? In that sense, like, there's a lot of variety of discussions right now, and as I got it just outlined, you know, we see a lot of, like, you know, innovation cycles. We set off, like, possibilities dying out, other possibilities, like, you know, being, like, you know, in the future, like, you know, implemented, and ultimately the market decides what's going to be lasting and what's not going to be as relevant as it is today. So having said that, like, obviously, if there is a Euro stablecoin issued by Circle, like, for pay-per-use business models in the short run, I would not see it, because there's simply no adoption by, like, you know, kind of like the companies. So I would not see, like, you know, Lindner accepting, like, you know, a Euro stablecoin, and in that sense, like, at least the clients will. So that's why I wouldn't see that. In the long run, could be like, if it's if asset as a service business models walk the approach of like being hosted on a DLT infrastructure and being executed there, it would make sense under certain circumstances. Would a euro stablecoin like issued by Circle make sense in general? I would say yes, depending on like other use cases, for example, cross-border payments, already outlined in the beginning. Like treasury departments have a huge headache, transferring money between the several entities of the different states. We already outlined that in the paper as well, and you would actually see kind of efficiency gains and process cost reduction, and sense of that if you have a global stablecoin being sent from point A to point B, you would actually save some money. There's definitely some use cases there. And yeah, I would just say the same thing as Florian, and say the use case defines the benefit defines ultimately if something is implemented and lasts, or if something is just implemented in a pilot. I think the most important thing here to mention is that you will need to try it out. You will need to go into test phase and not only have a look at it from a theoretical perspective, but literally try it out, see what is the benefit, how can we implement it, what is the ease of implementation, what is the ease of the outcome in terms of money on the bank account. Does it save money? Does it earn me money? And with that criteria, you can evaluate whether stablecoin uses for your specific purpose the right one, or whether it's kind of a wrong turn.
Okay, so maybe Agatha, you have multiple backgrounds, also quite some knowledge in the DeFi space, and so on and so forth. After having heard all this, why do you think the US company Circle is launching a euro stable coin, which is of course wallet based, and therefore there are some frictions when applying it to B2B contexts?
Well, I suppose one of the reasons must be because euro is still one of the top currencies in the world. So there is certainly a void in that stablecoins space in terms of lack of a significant euro stablecoin. So I'm sure that I'm sure that the reason is purely commercial. Basically, there is a space in crypto space for a euro stablecoin, and there might be a business opportunity in Europe with the rising interest rates. There might be actually a business opportunity if Circle decides to come to Europe with its stablecoin. So I believe that this is coming. This innovation is definitely coming. I think it might be too early for some of the use cases. It might be still, the adoption might be low, but this is pretty much the only direction it's going into in that space. So it's just a matter of time. And there is certainly a space in the market for euro-denominated stablecoin, especially the one that Circle has designed, which is clearly designed with compliance in mind, because it's one-to-one collateralized with funds. So it's not an algorithmic stablecoin. It's a stablecoin that would comply with the direction that the regulatory scrutiny is going. So, for example, in Europe, there will be certain obligations on issuers to keep reserves in funds, in liquid funds, and this stablecoin seems to comply, to be able to comply with that kind of requirement. So, surely this regulatory framework will be copied in other parts of the world. So I think it's a very progressive and forward-looking move to issue a euro stablecoin on that basis at the moment.
Would somebody want to add some points here?
At the end, what I would like to add on that topic is someone has to be a first mover, and it's cool that they're doing that and they're trying it out. And I think that's in all that spaces. If Max wouldn't have started with Lindner Tractors to build asset as a service model, many would still couldn't discuss about that. And I think it's cool that there are some kind of entrepreneurs trying it out, and then we will find the adoption and whether it's worthwhile having it or not. And everyone who is doing it is not doing it for the sake of just trying it out, but they believe there's a kind of business case behind, and they have a clear perspective on adoption rate, and that's what we often do with our clients. It's basically we think about exactly this adoption rate and how the model could be scaled up and transferred potentially to other use cases. And no one is doing it just for fun and for the purpose of being a pioneer, but they're doing it because they believe there's a business case behind it. So I think in the future will tell us whether they are right, but at least there will be probably many others following up and coming with kind of similar ideas, and who finds the best use cases will survive.
Yeah, it's a very nice summary, but it could have been the closing words, Florian, but we are not yet finished. I would like to touch upon the cross-border payments, right? Because in high-frequent payment corridors, say Germany, Switzerland, you know, it works quite well, right? But even though I recently had to do a payment towards Switzerland, it was underway 3 days. And the money was a very small amount, and the payment fee was 35 euro. Yeah, so this really speaks for quite some inefficiency, even in a high frequent payment corridor. With a stablecoin, doesn't matter which, I could have had the same event happening within a couple of seconds. And this basically with close to zero transaction costs, and the settlement time would also be very, very fast, right? So there are benefits of stablecoins in highly frequent payment corridors, but then even more so in less frequent payment corridors, right? So the payment, so why I'm really focusing on this point, that the benefit is really there, right? The benefit is there. I experience this now multiply personally, and this must also be happening for other people. In case the benefit is there of stablecoins, right? Can this benefit not be brought towards other people in the cross-border context, right? In the B2B context, you know, it could be business models like assets as a service, could just be cross-border payments across companies, and so on and so forth, right? But why is it so difficult to basically bring this benefit of cross-border payment efficiency into business?
The pressure is too little. The pressure on cost, there are people like you paying the 35 euros for the transaction. And as long as there's sufficient amount of people doing that, there's too little pressure to kind of change the model.
Yes, like fully convening that point from Florian. And secondly, what I would also add is like risk. Ultimately, it's a new technology. And like, you know, if you would just think about, okay, then we just take like a normal Sparkasse or Commerzbank or whoever that is, and like, you know, building up like a stablecoin payment rail. Like ultimately, this is something for B2C, which is very heavily, and then like, you know, B2B is moving even slower. So like, you know, ultimately, as said before, payments is not like an innovative space where you say like, hey, I have the new payment gateway. So it's like not like having a new iPhone. So it's not something which is pretty cool, but it's just something which needs to work as a kind of an infrastructure. So I'm not easily running around and saying like, hey, payments are pretty cool. Like, you know, it's so innovative. Like, you know, that's basically people like, you know, in transactions themselves. But usually, like, you know, in the B2B field and B2C field, most of the people just say this needs to work. As you just said, Philip, it needs to arrive, it needs to be cheap, and it needs to be fast. So that's basically like, you know, the simple, like, you know, kind of clue for having like, you know, a sufficient payment landscape. And having said that, like, you know, obviously everything which is like producing a risk and which is not earning you money, and transactions are not earning any bank any money. Like, you know, it's not a field where everybody's like looking into and saying, okay, how can we make it like more cooler, or how can we make it better? Because ultimately we don't earn that much money with it. Like for banks, like they usually earn money in restructuring cases and refinancing cases. And transaction is just something which they need to do because like ultimately their clients want to send some money from point A to point B. So it's like a necessary evil in that sense. So that's why I would say it's very like hard. And even though you had like, you know, a lot of payment innovation in the recent years, buy now, pay later being one of the trends, you had other trends in the payment space. There's a lot of things happening there, but like usually it only happens because, as said, like it's usually transactions, and transactions doesn't earn any bank any money.
Mm-hmm.
Yeah, that's a good point. Agatha and Benjamin, would you like to add something here?
I just wanted to say that the 35 euro burden for you is a 35 euro benefit for someone else. And at the moment, it's the benefit of the financial sector as a whole. So there might not be that much of an incentive to try to drive the innovation that basically reduces cost for individuals, but also reduces profit and profit margin for financial institutions.
Yeah, fine. So I really acknowledge
maybe
what
to
you
add
said.
up, Philip, like one last point here, like, you know, maybe to add up on that, like What should not happen is though, like, we saw a similar kind of like trend, like back in the days with like, kind of like the B2C payment space. So like, banks didn't want to like, face payments. They actually said like, okay, there is payment service providers coming into the game. There is Visa, MasterCard, Amex, Apple Pay, Google Pay. They didn't really want to take care of all of that. Like what ultimately happened is that they're entirely blind. So they don't know what their customers using their money for. They can't make use of any data. They're not like, they're kind of like blind, but they only like kind of the account and gateway keeper. And we should avoid this scenario in B2B payments because we already did that in B2C payments. So we should avoid this scenario in B2B payments at all costs, whether it's a stablecoin or another payment like railway, which you want to build up. I'm not discussing now the point like the market will show, but ultimately you should not make the same mistake and just avoiding the space and saying like, yeah, somebody will provide a solution for that. You should rather be active in the space and search actively for a solution. Other than that, we see the same kind of a similar development in the B2B payment space as you saw in the B2C payment space. Just closing remarks there.
Yeah, interesting points. We had one person in the audience pointing towards Bitcoin, that Bitcoin could be used for cross-border payments efficiently. And actually, this is also what an entrepreneur in the US called Jack Mellers is doing. So it could be a way to go to use also Bitcoin as a settlement tool in between. But still then, especially from a corporate context, you have to somehow get Bitcoins out of the accounting, and you have to get euros and dollars inside your accounting schemes, right? I think that's still for sure in a corporate context. Yeah, I think we are already at the end. Thanks very much. Anything to be said by one of you guys? Otherwise, I would propose to close this session and meet again here. Next time, probably we will speak again about crypto assets and Bitcoin.
Thank you very much. It was an exciting discussion. Thank you for having us.
Thank you.
Thank you.
Thanks. Okay, then have a nice day and meeting you soon. Goodbye.
Thank you. Bye-bye.
Thank you. Bye.